Hello, everybody. Welcome to this Let's Learn Futures webinar series brought to you by Bursa Malaysia Derivatives. So this is Shane Chu from LiveChamp, and today we are very excited to be hosting you this session called Risk and Money Management Strategies for Maximizing Trading Results. Now, as you know, when it comes to trading, risk and money management is of utmost importance, because if you don't do proper risk and money management, then one time you have an error or the market go against you, then you might blow out your entire account. So that's why, especially when it comes to futures trading, it's even more important for you to do risk and money management, because futures is a leverage product. And today we had a very experienced speaker who is here with us today to talk about this topic. Okay, he's none other than David Lowe. So later I will introduce his background for a little bit. All right. So if you're here today, please let me know if you can hear me, see our screen, and see my webcam. If you can, please type yes and maybe tell us where you are tuning in from. We have overwhelming response for these sessions. All right. So all cool. Well, we have friends from Ipoh, Sabah, KK, KL, Penang. Welcome. Yeah, so right now I think Penang is also under CMCO. So for certain area, I think Mukim 12, right? So take care for our friends here from Penang. All right, so disclaimer, whatever we share on this webinar is only for educational purpose. In no way that I give any buy or sell signal for you to long or short any futures contract or any investment that you want to make. So if you decide to do any investment decisions, you do it at your own risk. Now, Bursa Malaysia Derivative webinars we have concluded more than 10. I think this is probably maybe a 16 sessions. So we still have 6 more to go for the entire year. So for next Thursday, we'll be talking about a session on Bahasa Melayu, which is on konsep pemikiran perdagangan yang berjaya. Okay, so if you want to learn more about this, so remember to reserve your Thursday night for us, because every Thursday night, usually on every Thursday night, we'll do a session on futures. All right, so so it gives me great pleasure to introduce David to you. Okay, he is a veteran, industry veteran in this futures industry. Okay, so he is a trader and managing partner of Exmodius Trading Group PLT, a consultancy firm specializing in bespoke trading strategies and coaching for private and corporate clients in the equity commodity derivative markets. He has 24 years of experience in Malaysia's listed derivatives industry. So before starting his own consultancy, David held leadership positions in futures brokering divisions of major investment banks in Malaysia. So he served as the president of the Malaysian Futures Brokers Association between 2018 and 2019. As a fervent believer in trader education, David has spoken in seminars and workshops to over 5,000 retail traders on trading Bursa Malaysia derivatives, as well as the CME, SGX, and Hong Kong exchange markets. His work includes live market trading sessions and webinars. So he has also been a trainer for licensed brokers for the continuing professional education program courses of the Securities Industry Development Corporations. So David has participated as a panel speaker at international palm oil industry events such as POC 2019 and POTS India 2019. So as you can see, his background is awesome. All right. So today he is here, and we are very proud to have him here to share with you how you can do risk and money management strategy. All right. With that, I hand over the session to you, David.
Thank you, Shane. Okay, so I'm going to share screen. Okay, let me show you my screen.
All right.
Okay, you see my face again. But anyway, thank you so much, Shane, for the wonderful introduction, and a big thank you goes to Bursa Malaysia Derivatives as well for hosting and sponsoring this evening's program. I would like to thank all of you for taking the time to join this webinar And I hope everyone is keeping safe and taking good care of your health. Friends in Sabah, friends all over Malaysia. I'm in KL, so KL also is under strict orders as well. Penang Lang, I'm from Penang as well. Please take good care. Don't run around too
Hey,
much.
I don't know you're
Penang
also from
people,
Penang.
yeah,
I'm
Penang
also from
people
Penang.
love to eat everywhere, so so have to take good care of your health. Okay, that's very important, huh? Yeah, you need good health to do good trading as well. Okay, so we have a lot of information to share with you this evening. So if you have a pen and a notebook, it'll be good. Take it out, and we hope that you will take back lots of good ideas for your trading this evening. Okay, today will be a part three of my four-part series on learning how to trade BMD futures. Those of you who have joined me for the last two sessions, you would have learned how to instantly read the immediate trend of the futures market. You also would have learned the ABC and the AO momentum method for setting up your entries and exits in the markets for any time frame that you are trading. And but for those who did not join the previous sessions, you can still catch those videos uploaded on the LiveChamp website and also the Bursa website. I think details will be given by Shane on those links on how to link to all those videos that we are uploaded. Okay, so today we are going to talk about a very important subject. Okay, this topic risk and money management strategies for maximizing your trading results is extremely crucial. I think this session, honestly, if you ask me, is even more critical to learn compared to just the trading methods. So this is what we will cover. Okay, and three main points tonight that we will cover is number one, learn about leverage and the critical understanding of the crucial role of risk management in futures trading, especially because futures trading is a leverage product. Okay, so it's very important to understand risk management in these terms. The second is to understand the key measures of sound risk money management in trading. Okay, what are the measures? What are the things that you need to look out for? Okay, how to measure your effectiveness when you're trading. And the last point is how to implement a risk and money management strategy, which is suited for your individual trading strategy, right? So we're going to look at what is the game plan and putting it all together in the game plan at the end of this session. Okay, so let's jump right into it. When we talk about building a trading strategy, normally there are three ingredients. Okay, there is the methodology. Okay, methodology is something that a lot of traders and a lot of people want to look at, because this is like, how do I enter the market at the best prices, or how do I get a method that gives me the best probability of success in trading and all that. So methodology is naturally something that everybody looks at. Okay, and everybody yearns to have a good one, and I think that's important as well, methodology. But if you see from this picture over here, you have three large oval spaces, right? And methodology is the smaller part of the oval space compared to money management. Okay, money management is even a more critical element in the trading strategy. And of course, lastly is trading psychology, which is a session we will have in December to talk about trading psychology, which is a very important part of trading as well. Because without trading psychology settled, or if you don't have the correct mental mindset, you will not be able to implement both methodology and money management. Okay, but in terms of trading mechanics and all that, money management is extremely crucial. Okay, and we will see why tonight. So in terms of a optimal trading plan, I think this is something that we have to keep in mind to keep things simple. Okay, simplicity in trading wins over complexity. Okay, and I want to tell you my experience. My experience is as a I design algorithm trading strategies using AI and all that for my own trading. Okay, and as I design many and I go through thousands, not thousands, maybe hundreds of strategies. Okay, and the key thing is this: when I design these algo trading strategies, I'm looking for a measure, and there's measure of complexity. I'm looking for the complexity to be low. That means the strategy is simple, not too many inputs and not too many conditions. Okay, the higher the complexity of even a program for trading and algo trading, the more less robust is that strategy. And the simpler, if I can get my complexity measured down, I find that the strategy will be more robust and being able to last different types of market situations. So in terms of looking at trading, uh, simplicity is very, very important. Okay, of course, it needs to have a logical and rational approach. There must your strategy must be thought through. Okay, you must have some logical and rational what do you call that approach to it. Okay, you of course need to have clear rules for entry, stop loss, and exits. Okay, this is the methodology part, and most importantly, you must be able to have a system that has a positive expectancy. And later we'll talk about what is this positive expectancy, right? So bear in mind, in your trading, if you find that you have been adding more and more complexity into it, more and more technical indicators, you are actually making your trading more difficult. Okay, and we will address also complexity when we talk about trading psychology, because it's got to do a lot about making decisions. And if you have very complex decisions to make when you need to trade, then you'll be very slow to react to the market conditions. So very important to have simplicity, and simplicity wins always over complexity. Keep that in mind. Okay, so the most crucial lesson in trading futures is this. Okay, understanding leverage. And what is leverage? Okay, leverage is basically because the exchange don't charge you so much margins. Let's say, for example, you want to trade one contract of crude palm oil. Okay, one contract of crude palm oil at today's prices. So today, crude palm oil 1 metric ton is 3,000 ringgit. And one contract of crude palm oil is 25 metric tons. So the value of one contract of palm oil in today's prices is 75,000 ringgit. Okay, but the exchange says you want to buy or sell one contract of CPO, you don't need to give me 75,000. Just give me 4,005. That is the margins. So because the margins are low compared to the value of the contract that you're trading, you have this thing called leverage. Okay, so for those of you who have a calculator, you can divide 75,000 divided by 4,000. How many multiples of leverage you have, right? So you can see that leverage is quite high for trading futures, and this is something that you need to take aware of, be very aware of, because leverage can work both ways. Okay, leverage can multiply your and enhance your returns, but on the other side, like a double-edged sword, it can actually cut you if you don't know how to handle it. So the risk from trading futures inherently lies in not understanding the negative effects of leverage, right? A lot of people are excited about the positive effect of leverage. You know, the returns are so much higher and so much enhanced, but they forget that this leverage works both ways, right? So if you don't understand the negative effects of leverage, then you can be hurt. Okay, so managing risk is actually about managing, number one, leverage, your exposure, and your losses, and this is the key to successful trading. Okay, and this is leverage. Okay, just a simple diagram to show you. It means that with a smaller amount of capital, you can actually move a lot of exposure. So in terms of futures, it's highly leveraged, and you look over here, one piece of stone can carry 4 or 5 big stones over here. Okay, so it's a very powerful tool. Okay, but leverage is extremely important as well, because it's it makes your capital very efficient. Okay, you can control a larger size investment with a smaller capital outlay, and typically in futures trading, the amount of leverage is between 5 to 30 times. So you can see it can be very, very powerful. Okay, what does it mean when you have 30 times leverage? okay, if you have 30 times leverage, if your underlying product or asset you're trading, whether it's an index or whether it's crude palm oil prices, if the underlying moves 1%, okay, your account or your money or your profits will move 30 times that, if that is your leverage, right? So can you imagine if let me show you an example. Next one, I think make it clearer. So leverage, how it works, okay? And this is a example of using leverage in the Malaysian FKLI contract, which is the composite index futures contract traded on Bursa Malaysia derivatives. So here we compare between two persons, okay? The first is a cash trader, right, who buys 80,000 worth of Malaysian shares, right? In terms of settlement, when settlement comes, he would have to pay 80,000 for his share purchase. And this is what we call a cash purchase without leverage. Now, if you're a savvy trader and you know that there's this contract called FKLI in Bursa Malaysia, you can go in and do the same thing, very similar to the cash trader. You can go, say, for example, if you buy the index say at 1006, right? 1006 FKLI, if you buy one contract at 1006 points, it will be equivalent to 80,000 notional value of a basket of KLCI index stocks as well. Okay, basically how you get the 80,000 is you multiply 1600 times 50, because 1 point is 50. So 1600 times 50, you get 80,000. So that is the notional value of the shares that you have in your when you're trading one futures contract. Okay, and what is the margin needed? Okay, it's approximately 4,000 to have one position in the FKLI. So basically, you have equivalent exposures in the equity market, whether as a cash trader or as a futures trader. Now, this FKLI contract, the 80,000 divided by 4,000 will give you a 20 times leverage, right? 80,000 divided by 4,000, you get 20 times. So what happens is this: if the equity stock prices were to go up by 10%, okay, both the cash and the savvy futures trader would have made 8,000, right? Both of them made 8,000 because market 80,000 worth of shares go up by 10%. Both of you will make 8,000. Now the returns is very different. Okay, the returns for the cash trader who put up 80,000 ringgit in cash and made 8,000 is, of course, he made 10%. But you as a futures trader, you only put up 4,000, okay, and then you make 8,000 in profits. So your profits is 200%. Okay, so this is a multiple, a 20 times multiple of the return. 20 times 10%, you get 200%. Okay, so this is the upside of leverage. Now the question is this: what if the stock market or the shares went down by 10%? Okay, that's a key question. Okay, if you are a cash trader, of course, you lost 10%. How much? You lost 8,000, right? The futures trader will also what do you call that? Lose 8,000, same, right? But you can see here your when you started, your capital was 4,000, and now you have 8,000 loss, right? So that's a 200% loss as well. So in C, leverage works both ways. Okay, so the key to trading futures is how to control the risk and how to manage the leverage. Okay, this is a very key understanding to have. Let's move on. So is leverage your friend or your enemy? Okay, so what are the pros? Of course, the pros, smaller capital outlay, you can control larger amount of exposure, greatly enhance your capital. The better, higher the leverage, the more efficient use of your capital, and professionals know how to take advantage of this tool. So you need to be like a professional when you want to use leverage. Okay, and if you don't know how to use it, this is what will happen. A lot of investors will easily overtrade. They say, wow, okay, now I have a capital of say 80,000 ring. I can do 20 lots of FKLI, 4,000 each only. I can hugely make a big bet. Okay, so you take on risk, you overtrade and take more risk than you can actually afford. Okay, and this will greatly multiply losses as well. Now you've seen, if market goes against you and you don't know how to manage, you will greatly multiply your losses, and losses could go beyond initial capital. So this is something you really need to know when you are trading futures. Okay, this is something that you need to be aware. If you don't control your losses, it could go beyond your initial capital. Okay, but don't be afraid of it. I've traded futures for a long time, and I never had this situation because I knew how to control the leverage and my risk. Okay, so amateur investors or new investors who are ignorant of how to use leverage may make serious losses. Okay, so this evening is a very, very important session for those who are trading futures, and for those who have already been trading futures, it's an important reminder on why it is important to understand this risk management. Okay, so let's talk about knowing where to land before you take off. Okay, so before you go into any trade, okay, the most important thing is you need to know about your exit. Okay, so before you take off your plane, you better know where you're going to land your plane, right? So you cannot like take off then decide to, oh, okay, and I now decide where to land when after I've taken off. Okay, so where you land, which is your exit plan for your trades, is a very critical part of your trading plan. Okay, so if you're captain of your trading, you must have your plan all worked out, okay, before you even start your engine and fly your plane. Okay, so there's always this quote, which I think I forgot which is the famous writer, trader. He said that money is made not in when you buy, but when you sell. Okay, and any monkey can enter a trade, but money is made or lost when you exit it. So this is a very crucial thing, right? So you need to have your exit strategies all planned out before you take on a trade. Okay, and what are the exit strategies that you need all planned out? Is number one, where are you going to have your stop losses? Okay, where is your targeted profit taking area? Okay, what prices are your targeted profit taking, and what are your exits if the trade don't go anywhere? It's not, it's not like going anywhere. What do you do, and when do you trade? When do you get out? Okay, if your trade is going nowhere. So these are the three things and the three exit strategies that you need to have before you actually put on a trade. But the most critical of all, the most critical exit of all is this thing called the stop loss. Okay, and I called it your safety airbag, right? So all the modern cars these days, they have a airbag, right? So all cars are equipped. I think it's mandatory to have airbags in your cars these days. So what are the airbags for? Airbags are for in case, okay, the remote chance or you have an accident, the airbag will save your life, right? So a stop loss is a very important thing to have. And I would say that if you're trading, whether it's futures or whether it's equity or anything that you trade, you need to have this strategy, right? So right on top there, you can see in bold and in capitalized, do not trade if you do not have a defined stop loss strategy, right? I'll say it again, do not trade if you do not have a defined stop loss strategy. Of all the slides tonight, this may be the most important slide, okay? So I will say it again for your benefit. Some people will say I'm Cheong Hei or long-winded. Do not trade if you do not have a defined stop loss strategy, okay? Why? Because not all trades will be winners, okay? Let's be practical. If every trade you go in, you win, then you don't need to be sitting in this webinar anymore, right? Because not all trades will be winners. We win sometimes, we make trades that are not so good sometimes. So what do you do when you make some trades or the trades didn't develop as you expected? So the stop loss actually preserves the capital for the winners that will come. Okay, so it's a very, very important as part of the strategy in trading is preserve your capital, because you will have trades that will work. Okay, and that time when your trades are working for you, you will need to have your capital. If you are not in a game, how can you actually make the winners or make those winning trades, right? So the strategy is this: every time before you put an order, or every time immediately you put a stop loss on every order that you give or enter in the market. Okay, and you must know your exit before you even enter any trades, right? So before you actually trade, you must measure the loss or measure the risk that you're going to take in every trade before you even put it in. Okay, so once you put in a trade, you must put in that stop loss order. That means you need to activate your and put your safety airbag in place. right? So in terms of stops, a very general guide is to put your stop where the loss does not exceed 2 to 5% of your account equity. Well, 2 to 5% depending on your ability to take risks, right? But even if you take every single trade, if you're taking a 5%, 5% is actually on the high side of the range already, right? So you should work between the guidelines that you don't risk more than 2 to 5% of your account equity on every trade that you take, right? So that's the guideline for putting stop losses. So, okay, a quick recap is the last two sessions we talked about ABC trading systems and the AO systems. I won't delve too much on this. I'll just put in a reminder where to put your stop loss placements. So you have this buy signal trigger and sell signal trigger. Okay, you pick where to put your, I'll show you graphically. Okay, this is where you put your stop loss, this is where you buy, and then you either put your stop losses at A or C -1 tick. Okay, those of you who are not familiar with this ABC trade signals, go back to those two videos that we did the couple of months back and go and have a look. I already put in that in those slides where you put your stop losses, where you control your risk. This is just a recap for those to remind them. Okay, this is a recap for putting stop loss in a trade sell signal. Okay, I won't spend too much time on this because we already covered this. And this is also for the AO momentum trading strategy, where to put your stops. Okay, you have the stop loss 1 and stop loss 2, which is basically putting your stop loss 1, 2 ticks below the reversal wave bottom. And then for the stop loss 2 is to put it 1 to 2 ticks below or above the AO signal bar. Okay, all those details on putting stop loss or AO is also in the previous video. So please go back and have a look at the video and see how we can do this. So buy signal, this is the graphical, what do you call that, representation of those stop loss that we spoke about for AO. This is the buy signal and where to put the stop loss. And these are the sell signals and where you put the stop loss. Okay, so we have a lot to cover, so I won't go and delve too much on this. You can refer back to the signals and the stop loss placement in the previous videos. Okay, another idea I want to share with you is this, using ATR for placing stop loss. This is a good method to sort of gauge or measure the amount of stop loss you should put. Okay, and this is an indicator. ATR is called average true range, and it's an indicator developed by J. Wells Wilder, and it's actually a measure of volatility, right? So large ranges of ATR indicate high volatility and small ranges indicate low volatility. So, but ATR is not an indication for price direction, it's just for volatility. And ATR was a basis of stops. This turtle trading system, this very famous turtle trading system, those of you who have not heard of it, it's good to check out and read this legendary story of how two top traders train a group of what they call turtle traders, which is actually their disciples, to become top class traders in the world. And this turtle trading system, they use ATR as a form of stop loss. And their guideline is they typically use 2 times the ATR. And later we will see in some of the methods that we'll talk about later how to use this 2 times ATR. And 2 times ATR is actually quite a viable stop loss level. And you will see that even when you're trading AOs or ABC system, when you put the stop, roughly the guide is about two times the ATR, right? So we will go in and talk about ATR later. Okay, now I want to talk about drawdowns, and this is very, very important. Okay, and it comes to drawdown. What is drawdown? Basically, when you're trading. Okay, so in this chart on my right and on your right, you can see the trading account size, which is the money, that means your profits. Okay, or your trading equity, and then this is the number of trades. Now, in every trading system, there will be this thing called drawdown. Okay, and if you are developing trading systems or you've been in trading for a long time, you've heard of this. People will ask, what is your trading system drawdown? Okay, it's either represented in the absolute amount of money or in represented in percentage. Okay, say basically drawdown is from this peak to this bottom. What is the measurement before it makes back a new high? So these drawdowns are very typical happening when you're trading. In trading is very common. You will see your equity won't go up in a straight line. You will have its ups and downs. Okay, and hopefully in a good trading strategy, the downs or the drawdowns are as shallow as possible. Okay, and then you have this up trending equity curve, right? Drawdowns are normally calculated between the difference of the relative peaks and the relative troughs. Troughs are the bottoms. Okay, and drawdown is really a part of trading. Okay, and the ability to handle drawdown is very important, because drawdown is the pain part, the losing streak part, okay, in trading. And this is where your trading psychology will be tested. Okay, but being able to handle the losing trades is what actually separate the successful traders from the ex-traders, right? And when it comes to drawdowns, the most important key element is the risk management. Okay, if your risk management is solid, okay, your risk management is what do you call that, very robust, then you will be able to survive the drawdowns. Okay, and the other part of drawdowns is you need to have enough capitalization. A lot of traders go into the futures market and they hear that, futures market, because of leverage you can have very good returns. They tend to feel that, hey, I just start with a very small capital and try out. Okay, in trading you need to have enough capitalization. Okay, because with good enough capitalization, you will be able to use another part of the risk and money management, which is called position sizing. And that's one of the critical elements of making your trading more effective and your results more effective. Right, we'll see later what this means. So you need to be well capitalized. Okay, so some people say, hey, I don't have enough capital yet. What should you do? Okay, you either downsize to trades on where you take smaller risks. Okay, you downsize to maybe trading on day trades, because the sizes of your losses are less and the risk that you take is less. So we'll talk about those strategies afterwards, right? So capitalization is something that you need to be very clear. You need to have enough capital to trade. Okay, and I'm going a bit ahead of myself now by saying that one of the key things about trading psychology is scared money will not make money. Okay, so if your capitalization is not enough, okay, basically scared money, this money cannot lose one, you will have trouble, because your trading psychology part will not be sound. Okay, so this is something that I'll cover in December, but just to say it now. Let's move on. Okay, so now we're going to cover the money management concepts. Okay, how to right size your exposure on your trades. So this is a book that I would highly recommend. This is an old book. I read this in the mid 1990s. They've got newer versions of this with other people that they interview. But this is a book by Jack Schwager. And Jack Schwager went around to interview all the top traders during that time, in the 1990s and the 80s. And these were all the people he spoke to. Okay, I won't read out the whole list, but you can see that all of these people are very successful traders. They traded in futures, they traded in stocks, they traded in treasury bonds. Okay, this Paul Tudor Jones is a very famous fund manager, hedge fund manager. He averaged triple-digit returns for 5 consecutive years. Is an amazing record. Okay, at Seikota, amazing returns over 16 years. Bill Lipschutz, all these guys. Basically, when Jack Schwager went to interview them, he was asking basically the same questions to all these successful traders. Okay, and one of those questions is like, I've spoken to all different types of traders. They all trade different methods, they have different styles. Some are very aggressive, some are very conservative. Now, what is the key concept of all these traders? All the best traders in the world have this thing called risk and money management, especially money management. Okay, they all adhere to a very clear program of risk and money management, right? And what are these money management concepts to understand? Okay, these are the few things that you need to understand. Number one is position sizing is the key factor in money management. Okay, position sizing is how much or how big of a position to trade or take. Okay, so how much capital is at risk on each particular trade. Okay, these are important considerations. Okay, the exposure that you expose yourself every time you trade. Okay, the second part to measure is about the expectancy of your trading system. Okay, and normally it's measured by these few crucial measurements. Number one is the win-loss ratio. What is the win-loss ratio? The win-loss ratio is your average winning trade in currency, in dollars or in ringgit, divided by your average losing trade in dollars or currency, right? So in terms of looking at the guideline, a win-loss ratio of 2 suggests a robust trading system or method. If your method can give you a win-loss ratio of 2, that means if you win an average win of 2 times your average loss. Okay, that means if you make, just to make it simple, if you make $10 and if you lose $5. That's 2 to 1. Okay, so this win-loss ratio is a key thing to look at. Okay, and then the other measure is called profit factor. It's very similar to win-loss ratio, but profit factor is the gross profit. That means the total gross profit of the winning trades divided by the gross loss of the losing trades. Okay, so a profit factor of 1.5 above suggests a very robust trading system. So these are measures: win-loss ratio of 2, a profit factor of 1.5. Now the last measure is percentage win, or percentage profitable, and this is something that a lot of people tend to think of only, okay, in isolation, and that would be a mistake to ask that, hey, if my trading system have a 60% win rate or 60% profitable rate, is it a good trading system? That is only half the equation. Okay, so later we will see, because the top two win-loss ratio is even very, very important. Okay, and this needs to work together. The win-loss ratio and the percentage win needs to work together, right? And we'll see how it goes. Okay, now I want to share with you a trading system. Okay, you don't have to remember this trading system. You can read about this trading system in this book called Ryan Jones. I've put down here. Ryan Jones, The Trading Game, Playing by the Numbers to Make Millions. Is a Wiley and Sons book, a very good book on trading. And in his book, he introduced these trading systems. But his book is actually talking about money management systems. Okay, but he's saying that he have developed this trading system. Okay, he put there, these are the rules for buying. Okay, and there's these factors here: X days and Y days. Okay, which he didn't review what's the X days and Y days. Okay, this is the buy rule and this is the sell rule. Okay, and he says that basically the X and Y days are not so crucial, because after he has tested various combinations and X and Y days, it seems that his results are quite consistent. So those of you who are interested to go and test out what this trading system is, you can go and test out various variables of X and Y's. Okay, but I want you to show you the results from this RJ Ryan Jones trading system rules. Okay, and we want to learn money management and the measures of money management using this system. Okay, and these are the results. He traded 8 different commodity markets or futures markets using this system. Okay, and these are the results. Okay, so the first tabulation is he traded bonds with it. Okay, and these are the results of his trading. He had a net profit of 92,000. Winners is 30 over 48. Losers, so his winning percentage is 63. Okay, now let's just focus on these two measures. Okay, winning percentage, which is the win percentage, and the win-loss ratio, which is the average profit divided by the average loss. Okay, so in terms of bonds, this RJ trading system had a win percentage of 63% and a win-loss ratio of 3.29. Fantastic. Okay, when he traded Swiss francs with this system, it got a winning ratio of 56% and then a win-loss ratio of 2.19. Well, not bad, because it's above 2. Okay, let's go on. He traded crude oil with this system. He got a win percentage of 59% and a win-loss ratio of 2.8. very good. Okay, win-loss ratio above 2.8. And then he traded wheat with this. He got a winning percentage of 57% and then a win-loss ratio of 1.93%. Okay, this was probably the only one that went slightly below 2, but 1.3 is still a very respectable number for win-loss ratio. Then he traded 10-year, these are treasury notes. He had a winning percentage of 60%, a win-loss ratio of 2.92. Also very, very good. Okay, and he traded Japanese yen with it. He had a winning ratio of a winning percentage of 57%, win-loss ratio of 2.6. Very good, above 2. Now for Deutschmark and euro dollars, you see winning percentage 63%, 2.6, win-loss ratio. Win percent for euro dollar 57% and win loss ratio of 2.02. So when you all aggregate it up, this is the combined results of all 8 markets. He of course made money. He made $500,000 on this. His win percentage was averagely 57% and his win loss ratio was 2.8%. Now I want to draw your attention to this box over here. Okay, and let's talk about what is called a break-even system. Okay, I wouldn't even say this is a break-even system. This one I think sure lose. Okay, lose to who? Lose to the broker because of your slippage on your brokerage. Okay, a break-even system is a system where your winning percentage is 50%. That means you make half your trades and you lose half your trades. Okay, in terms of your percentage. And then your win-loss ratio is 1. That means you made $10, you lose $10. Okay, I'm sure you can understand by looking at that system who is the winner. Okay, the winner will be where you lose is all the slippage in brokerage, exchange fees, and all that, right? So this system, if you have a system that makes 50% win percentage and only wins 1-to-1, then this is not a very viable system. Okay, you will lose in terms of the slippage. Okay, now what is a very good system? Okay, very good system, this is a measure, and these are the numbers that normally quoted for those trend traders and all that. They have a win percentage of 40%. Okay, these are top traders. Yeah, 40% long term. Okay, and they have a win loss ratio of 2. Okay, that means out of 10 trades, they will make 4 trades profitable trades and 6 non-profitable trades. But every time they make a profit, they'll make it 2 times the average loss. Okay, so we're saying that this is a good guideline. A very good system will have that. A win percentage. Okay, some of you may be surprised to find that win percentage is even below 50. Okay, some of you might think that I need my win percentage above 50 to make it good or have a good trading system, but you forgot. You need to remember that the win-loss ratio here is very important as well. Now, an almost holy grail system, that means this is a very holy grail system. People would define a holy grail system as something having a win percentage of 50 and a win-loss ratio of 2.5, right? Now, this is like holy grail already. But let's go back to RJ trading system and see what his win percentage is. It's 57%, okay, which is above this holy grail system, and a win-loss ratio of 2.8, which is also above this holy grail system, right? So if this excites you, perhaps you should go and test out the RJ trading systems and play with the variables of X and Y, okay? So almost holy grail system is only this, right? So for those who are shooting for 80% win percentage and all that, it may be a game that you're chasing the wrong what do you call the end of the tunnel. Okay, because the almost holy grail system is win percentage 50% and win loss ratio 2.5, and I've been doing a lot of iterations of trading strategies using the AIs, and what I realized is this. Besides these 2 numbers, okay, and this is an insight I want to give you. Okay, what you do is you multiply. Okay, you take these 2 numbers and you multiply it. Let's say, for example, win percentage of 50%. Okay, so 50% is 0.5. Okay, and then you multiply it by the win loss ratio. Okay, so 0.5 times 1, what do you get? You get 0.5. Okay, this measure is quite important. Okay, if you multiply these two figures, so a break-even system will give you a multiple of 0.5. So you know that if you have 0.5, it's not that great. Okay, things are not looking that great. So in a very good system, okay, what is the win percentage? 0.4 times the win-loss ratio 2, you get 0.4 times 2, you get 0.8. 0.8 is a very good system. Okay, a holy grail system, a win percentage 0.5 and win-loss ratio 2.5. Okay, so if you multiply 0.5 times 2.5, you get 1.25. So 1.25, if you can get the numbers of these two multiples at 1.25, you're having a fantastic system. Okay, now what if you have a win percentage of 0.3? Okay, 30%. Okay, so you need to have a better win-loss ratio. So these numbers, these two numbers will always balance out. Okay, so if you can achieve a multiples of 0.8 to 1.25, if your system measures that way, that means you have a very good solid system, right? So this is an insight to give to you, and these are the two very critical measures when it comes to money management. Okay, so let's go and look at position sizing. Now, when we talk about position sizing, let's take a hypothetical trading system, and this trading system is a coin flipping trading system. Okay, so you basically take a coin and flip it in the air 100 times. Okay, and each time the coin lands on head, you make $2. Each time the coin lands on tails, you lose $1. Okay, so what's the win-loss ratio for this game or this simulation of the trading? So it's 2 to 1. Okay, and suppose that we accept the probability that having heads or tails is 50-50. So you have this particular system has a win percentage of 50% and has a win-loss ratio of 2. Okay, so we flip these coins. Okay, and we see what's the results if we play this game 100 flips. Okay, so 100 flips, you have 50 flips that land on heads, which you make $2 each. You times 50, you have a net gain of 100, and you have 50 flips on tails, which you lose $1 each. Times 50 times, you loss of 50, and then you have a net gain after 100 flips of $50, right? So if you were given an initial sum of $100 to play, and you put $10 on every single flip of the coin, after 100 flips, you would have made 500. Not bad, right? In fact, very good. You put in 100 and then you made 500. That's fantastic. So can the deal be even better? Okay, it can be, right? Because so this is simulating a trading system. Now we are going to add this thing called position sizing, and this is what we're going to do. Okay, we're going to play it very differently. Same amount of capital, same game, same returns and all that. Okay, but let's see the results. Okay, we are going to vary the position sizing. Okay, there are 4 ways we can do it. The first way is we put 10% of our total account size on each flip. The first time we played, we put $10 each on each flip. Okay, but now we're going to vary it. A is a method where you put 10%. B is a method where you put 25% of your total account each flip of the trade. And C is 40%, very aggressive, of the total of your total account on each flip of the trade. And D is even more aggressive, 51% of the total account on each flip of the trade. Now, if you do this, what would be the results? Okay, remember in the first game previously, okay, we made 500 and we said, wow, 500, not bad. With a starting capital of 100, now you have 500. Okay, but if you position size, if you do it differently, like here, A, if he played it 10% of the time, after 100 flips, his $100 will turn into 4,007. This is a huge difference, right? And for B, when he puts 25%, after 100 flips, it's 100 will turn to 36,100. Who would have imagined that playing this kind of game, okay, $100 can become $36,100. Okay, that's amazing. And all you did different was just to change the size of your position. C, very aggressive, after 100 flips, turn 100 to 4,007. So you see, it doesn't mean that the more aggressive you get, the better it gets. There is a optimal level, and in this particular example, it looks like 36,000 is the topmost maximum return, and that's 25%. And D, when he put 55%, of course, at the end of it, he lost 31. So too aggressive, also you lose money, and there's an optimal. Okay, and for this particular risk reward ratio and for this win percentage, it's 25%. Okay, so if you have position sizing and you add that into your system, okay, you can turn even a normal mediocre system into a very, very good system. So that is where position sizing comes in, and it makes a very profound difference in your trading results. Okay, so in position sizing, you have two main schools. Okay, you have this thing called Martingale and anti-Martingale. Okay, these are strange, maybe strange terms to use, but those who have studied game theory or those who have studied casino gambling or casino games will understand what's Martingale and anti-Martingale. Okay, Martingale, I think, is something that a lot of people understand. Okay, basically it's up as you lose, down when you win. What does that mean? It means that, let's say for example, you play a game, okay, a betting game, and then you played one unit and you lost. Okay, a lot of people naturally the next bet will be 2 units. Okay, they double up. Okay, and then if they lose again, they double up again. Okay, and they lose again, they double up again. You know? So 1 becomes 2, become 4, down 16, and so on and so off. So this is a concept. If you use this in trading or even investing, it's going to spell trouble. Okay, and a lot of people use it in the market actually. Okay, and it's very familiar. Okay, when they make a trade and they lose, they double down. Okay, or otherwise known as averaging down. Okay, are you familiar with this word, averaging down? Averaging down is martingale. Okay, and in the long run, especially if you're trading leverage products, is a recipe for disaster. Okay, so I don't encourage you to use Martingale type of position sizing for trading. It's not recommended for trading. Okay, you may play some games with it, but then it's really not recommended for trading. Okay, for trading, you have to use what we call anti-Martingale. Right, which means you up as you win. That means if you make profits, you increase your sizes. Okay, and down as you lose. That means you reduce your exposure if your equity is you're losing money, right? So you only increase exposure on profits, and this will give you what we call geometric growth. Okay, geometric growth, where you earn more, you're earning more profits, and that what you can achieve with a single contract. Right. So if you're just trading single contracts, like the guy who was playing $10 per game, compared to the guy who was putting either 10% or 25%, there will be very different results at the end of that 100 flips of coins. Okay, so this is anti-Martingale is optimal for trading. Okay, of course, depending on what sort of account size and growth expectancy you will see the growth of your account. So go anti-Martingale for trading. Don't do the Martingale. Okay, so these are the concepts for position sizing. So let's talk about two. Okay, we are going to go into a bit of mathematics, so I hope you bear with me. Okay, for those who can't get it, don't worry, you still have this to refer to in the video, and you can slowly go through it. Okay, most money management system, a lot of people use this thing called fixed percentage money management. It's very popular, and especially for professional traders to use this, especially people who trade large capital, large account sizes. Okay, that's why a lot of professional traders use this system. It's very conservative. Okay, but for people who have very small account size, maybe it's a bit slower, right? So those with small account size may not like this system because it's very conservative. Okay, what this system does is it limits your losses to a fixed percentage of your account balance, which just now we're talking about is between 2 to 5% of your account balance, right? This is what your limits we are talking about. Okay, so here I'll give you an example of how to calculate how many lots to trade using this fixed percentage money management system. Okay, so basically the number of contracts is about your fixed percentage account limits. Okay, let's say for example, if your account balance is 30,000 and you say that 5% is my limit, my fixed percentage limit, So 5% is 1,005. Okay, and if my individual trade risk is 500, that means let's say if I trade one contract of FKLI, and if my one lot risk is 500 ringgit, then I will take my account balance times 5%, which is 1,005, divided by 500, which is my individual trade risk, and I can trade 3 contracts. So is that understood? Because the individual trade risk is the risk taken per trade. So what this fixed percentage money management system does for you, it tells you how many contracts you can trade. If your 5% risk limit is there, okay, and your individual trade risk is 500. Okay, so in terms of this system, you can calculate your exposure by using this formula. And for this particular example, is 3 contracts. Okay, let's see whether we have another one. Okay, here's another example. And current the account balance is 50,000. Let's say, for example, you started with 50,000 and you're trading the KLCI, and you assume that money management stop is 10 points, which is 500 ringgit. So your individual trade risk is 500, and your fixed percentage money management system limits is 5% of the account balance. Okay, so here you do your calculation. So with 50,000 ringgit of capital, how many contracts can you trade using the fixed percentage money management system? Okay, so in that case, you look at it, it's 5 contracts. Okay, using the formula, it's 5 contracts. Now, what if your account balance dropped to 45,000? Okay, there is some losses, and from 50,000 it went down to 45,000. So when you run the formula again, okay, based on this, you become 4.5. So to round it down to 4 contracts. So you see, if your balance in your equity goes down, you actually reduce your exposure. Now, what if your account balance rises to 60,000? You make some money, okay? So how many contracts can you trade? Using the same formula, it will calculate for you, and it's 6 contracts. So you can see the principle of the anti-martingale over here. If you lose money, you reduce your exposures. If you make money, you increase your exposures. Okay, so that's fixed percentage money management for you. There's another system that some people may prefer. Okay, it's more suitable for smaller account sizes, but some is debatable. Okay, some people prefer this. I use this personally. I like this. Okay, don't worry about the formulas. The formulas you can slowly look at the slides later at your leisure. Okay, so basically what the fixed capital money management says, basically it says that for every lot of trade, you need to have a certain fixed capital. So fixed unit capital, let's say for example, if it's 10,000 ringgit fixed unit FUC, your fixed unit capital, then if you have your account size of 30,000, you only trade 3 contracts. Okay, and the formula for the FUC is over here. Okay, you can see over here. I'll give you an example. Okay, in the next slide. Okay, say for example you're trading crude palm oil. Okay, and the FUC will require you to have this figure. Okay, if you have a measure, you need to have a system drawdown measure. And in terms of this particular measure, one of my systems, we have this 9,000 system drawdown measure. Okay, you input it into the formula. Okay, and I'm assuming here account balance of 10,000, and you have this thing called blow torch risk as well. Okay, what is blow torch risk? Is basically, as a trader, how much risk are you willing to lose? That means how much money are you willing to lose? And in this example, is 50%. That means if I lose 50% of my capital, I need to stop and relook at all my trading strategies. So I'm putting this input as 50%. So my FUC is drawdown divided by blow torch risk, which is 18,000. Okay, what does that mean? It means that for every 18,000 ringgit of capital that I have, I can trade 1 lot of CPO, because this is a CPO drawdown of 9,000. Okay, for this particular system. So I will only increase 1 contract for every 18,000 increase in my account balance. Okay, so this is FUC. So you have a choice between using the fixed fixed capital money management, or you can have the fixed percentage money management. These are the 2 popular ways of using money management in terms of measuring and counting what is the exposure that you should put on every trade. So I recommend that you explore these two methods. Okay, go back and look at the videos again and see which one works for you. Okay, so in terms of a summary of money management guidelines for trading, the first key important thing is preserve capital. Okay, we are trading a leveraged product, futures. So the key is preserve capital, and this will be your key to survival and prosperity. Most importantly, survival. If you can survive, then you can prosper. Okay, always trade with a stop. Okay, I'm not going to be long-winded here again, but then always trade with a stop. Okay, risk no more than 5% of your trading capital on any trade at any one time. Okay, calculate your win-loss ratio, aim for 2 or more if you can. Okay, use position sizing. Remember to increase sizes in profits and decrease sizes in loss. Okay, and this will ensure geometric growth. Don't do the other way. Don't do increase your size when you're losing money. Okay, only increase your size when you are in profits. And then we come to the objective of trading. Okay, basically is to win more trades than you lose and achieve profit margins on the winning trades that will be larger than the losers. So this is the key money management concept. And if you can do that, the cumulative effect of doing all this above is your pot of gold. Okay, so this is very, very, very important. Okay, I also want to share with you this chapter of Sun Tzu, The Art of War, chapter 4, which basically says that the good fighters put themselves first beyond the possibility of defeat. That means your money management is so rock solid. Okay, all you're waiting for, okay, and in Sun Tzu it said is waiting for the opportunity of defeating the enemy. That means the market will give you those profits. You defeat the enemy is like making profits in the markets. Okay, so to secure ourselves against defeat lies in your own hands. Okay, having your risk management, having your stop losses, that particular what do you call that strategy lies in your own hands. Okay, and the opportunity of defeating the enemy is provided by the enemy itself. Okay, I'm not saying that the market is an enemy, but that's where the market will gives you the profits. Okay, so thus the good fighter is able to secure himself against defeat, and this is very important. To be able to secure yourself against defeat is to have a very strong and robust risk and money management system in place, right? So after having all those things, of course, you need to keep statistics. If not, how are you going to measure your win-loss ratio and your win percentage, right? So stats to monitor at the minimum. These are the minimum stats you need to measure and keep records of. The number of trades, of course, the ratio of winning trades, which will determine your win percentage, the average profit per winning trade, the average loss per losing trade. Okay, and then calculate your win-loss ratio, which is AV divided by AL, to see whether it's 1/2 or 2 times. The higher, above 2 times, the better. And also look at what's your maximum equity drawdown measure. If your system goes into drawdown, what is the equity drawdown? Okay, so these are the minimum stats that you need to monitor when you're trading. Okay, I know this is the dreary part of trading. Okay, keeping records, but it is a very important part so that you know whether you're on track on a good risk and money management system that you are implementing. Okay, so to put it all together in a futures trading strategy, okay, the first one is determine your starting capital, and we said that start with enough capital so that you can do position sizing. Okay, so you need to ask yourself what's a good starting capital. Okay, you also need to, of course, look at what size of contracts you're trading. If you're trading things like CPO or FKLI, per contract, it's about 4,000 to 4,005 capital needed per contract. So you need to look at your particular amount of capital that you have, and also the capital you have will determine what sort of trading time frame. Okay, for trading time frames, if you trade longer trading time frames, if you trade daily charts, of course, if you trade weekly charts is of course too long. I feel daily chart is as long as you can get. If you hold positions, then when you hold positions, then you need to have more capital because your stop losses will tend to be larger and the absolute value will be larger. Okay, after you determine your starting capital, your next in your game plan is to determine your trading methodology. Okay, you may have already got your trading strategy. If you don't have, then check out the ABC method or the AO. I will recommend that you have a look at that. The third thing is then determine your risk and money management. Okay, so for example, if I'm trading FCPO and I use ATR as my guide to my stop losses, where I put stop losses, and it's interesting to see this FCPO ATR is something that I did I think 2 weeks ago, and I was looking at the daily ATR of 80 points. What does that mean? That means the FCPO on average, the high low, the range for the day is 80 points, and this is a lot. Okay, so 80 points is 2,000 ringgit. So there's a lot of potential for profits. There's also potential for losses if you don't take care of your positions. So this is something that you need to take care. The ATR for 60 minutes is 30 points. So if you're trading 60 minutes charts, the ATR is 30 points, which means it's 750, the range of the 60-minute chart. Okay, and the range for the 15 minutes chart is 15 points, which is 375. So if you look at this ATR and then you say, okay, a guideline to my guide to my protective stop loss is 2 times the ATR, then you can actually measure what is the risk. So if you're trading 15 minutes charts, okay, your 2 times ATR stop is also 375 times 2. Okay, so that's quite some money as well. Okay, something to consider. Now that's because the PAM or FCPO is very volatile. Okay, so if you think the FCPO is too volatile for you, then you can look for another contract. Perhaps look at the FKLI, which the ATRs are less aggressive, right? So that's one way to determine what contract to trade as well. That's very important. All right. So just looking at the FCPO example for you to for us to look at the game plan. Okay, a lot of you are already familiar with this slide. This is the contract spec slide. So the margins is 4,005 currently for trading one contract of FCPO. So in terms of looking at the futures trading strategy, this is how it could be. Let's say, for example, I have a starting capital of 30,000. That's what I have to start. I pick a trading methodology. So I say I trade ABC intraday method because the intraday range is so good. So I also don't want to take too much risk. So my trading time frame I decide is 15 minutes. Okay, what is my stop losses? Okay, 15 minutes is 375. So 2 times ATR is my protective stop loss. This is my airbag. It's 30 points, which is 750. Okay, so it is quite high as well. Okay, my contract margin is 4,005. So what else do I need to do? Now I need to put my money management, what do you call that, game plan to play. So I have 30,000 ringgit. How many contracts should I trade? Okay, so if I take individual trade risk, we're saying that 2 ATRs my individual trade risk. Okay, I'm using a fixed percentage money management system with limits set at 5% of my account balance. So 5% of 30,000 is 1,005. So with 30,000 ringgit, individual trade risk 750, number of contracts traded will be 5% times 30,000 divided by 750. I trade 2 contracts. Okay, so using the fixed money management, fixed percentage money management systems, I trade 2 contracts with 30,000 ringgit. If my account balance drops to 15,000, then I'll be trading 1 contract. If my account balance rises to 45,000, I will be trading 3 contracts. Okay, so that's how the game plan goes. So each step of the way you have your trading, your capital, your method, your money management, and your risk all put down. Okay, so these are the minimum things that you need to have in place before you actually start trading. Yes, you have your trading method, you have your methodology of entries and exits. You may use AO, you may use ABC system, but then you need to have this particular things, game plan for money management in place as well before you start trading. Okay, so yeah. Okay, this is just a continuation. Okay, and where is your profit target? Okay, so profit target, we say that we want to have our profits 2 times our stop losses. So if our stop loss is 750 ringgit, then we would have our profit target try to get 2 times that, which is 1,005 or 60 points. Okay, so that's how you plan your profit target as well. So yes, so we've come down to Q&A session. There are lots that we have covered. There are a lot of mathematics as well. So for those who are a bit part, what do you call that, blur because of the mathematics, don't worry. Go back to the video again when it's uploaded and relook at it. So now we're going to take questions. I'm going to go back to Shane. Shane will moderate the Q&A session. Back to you, Shane.
Yes. Thank you, David. Well, today we have a mathematics and statistics class. Okay, so as a trader, especially in the leverage products, as we have the speaker have put across the point very importantly to you, is that risk and money management is very important. Okay, so we must know exactly what are the win-loss ratio, what are the percentage winning, and what is the profit factor, and know how to do a position sizing so that we can have a solid trading system that can be profitable for us and build our first pot of gold or many multiple pots of gold. Okay, personally, I am my background is in mathematics, and I also believe in all these mathematical numbers. I believe in facts and mathematics, so I am also a big believer in all this system. All right, so let me see what are the questions you have. Okay, David, what is
Yes.
percentage time in DD? This asked by Kevin.
Oh, did I have a percentage timer in TT there?
Yes, correct. In the case studies, yes, you put in the percentage time in DD. What does that mean?
Wait, let me just go back to the slides.
Yes.
Which slide is it?
There are a few slides, I think, on case studies when you were going through the case study of crude palm oil or wheat or Swiss franc.
Oh, okay. DD is drawdown.
That means
Percentage
it's
of time in drawdown.
because I
Yeah.
noticed that sometimes the number is quite large, like 60%. I mean, do you mean that
Okay.
like 56%?
Percent.
That means
DD is drawdown. That means it's let's say for example the Deutsche Mark, right? You see over here. Okay. That means this particular system for Deutsche Mark, the RJ trading system, spent 56% of its time in a drawdown. That means it was the drawdown means losing money. Okay, 56% of the time. Okay,
okay.
and for
I
euro dollar you can see 64%.
I
So DD
actually
is drawdown.
don't really understand because you see the percentage winning is 63%, right?
Yeah.
If out of 100 trades, 63% are winning trades, then how does that relate to 56%
Okay,
in
in
drawdown?
terms of drawdown, right? And we saw this now in the drawdown figure. You need to see when you measure drawdown is from the peak, the peak of the hill, and to the bottom of the valley, right? So in terms of climbing back from the valley to back to the hill, you still have the winning trades and losing trades and winning trades and losing trades, right? So once you have that, once you go back up above the hill, then you're out of drawdown. Okay, so that a percentage of time is that measure of time you stayed between that peak and the bottom of the valley before you get back to the peak again.
Okay, I understand what I
I
mean.
hope
So you
that,
have to
yeah.
be
So it's a
higher than
measure of
the
time.
previous peak.
Yeah. Yes.
Okay.
So you still
So
will have your winning trades and losing trades in between. Okay, but this percentage of the time you will
so
spend
the lower the
in
number,
between.
the better it is.
Yes. The lower, then
Correct.
you have you don't spend so much time in drawdown. Okay, I hope that
Okay.
answers the question.
Yeah, when I graduated, I am always fascinated with all these numbers. So the next question is, could you explain again what is the difference between win-loss ratio and profit factor?
Okay. Now, over here, you can see, let's look at the Deutsche Mark. Okay, so a win-loss ratio is taking your average win. Look at this Deutsche Mark here, average win 3004 and average loss 1003. So when you divide 3004 by 1003, you get the 2.6. Okay, so that is the win-loss ratio. Now, profit factor is taking all your gross profits, which you don't have here, all your profits, all the profitable trade, all the total, you add together into one gross, and all your losing trades, you add together the losses, total losses, and total profits. You take the total profit divided by the total loss, you get the profit factor. which is 4.5. So here I don't have gross. I don't have gross. Yeah. So profit factor is gross profit divided by gross loss. Everything that you made on all the trades and everything you lost on the what on the losing trades. So that'll give you your profit factor. So you look at this profit factor for Deutsche Mark, 4.5 is extremely good, because anything above 1.5 is already a very strong system.
All right. The next question is your strategy in terms of money management and risk management applicable to other markets such as stocks and forex?
Okay. Obviously, all these are evergreen ideas. This applicable to all types of trading. Okay. What you need to do is you just need to tweak it a bit. For equities, is a bit different because you're trading shares in amount of share value. So it's slightly different. You need to tweak it, but the principles and concepts behind it is the same. All this about net profit, winning average, average win, average loss, and all that it's the same. It's just that the way shares traded compared to futures is by per contract basis, whereas shares is by exposure, in dollar terms exposure. Okay, so that needs a bit of tweaking. If you like to look at shares trading, the type of money management, I would recommend books by Van Tarp. Okay, Van Tarp has very good books on money management when it relates to equity markets as well. Right, and so other books I would recommend you to read is Ryan Jones, this person is named that, and also Ralph Vince. Ralph Vince is a very famous writer on money management as well. So these authors, if you check out, you will be able to get a good idea on using it on equities as well. I hope that answers your question. Yes, it is. Yeah. It applies to all.
So David, you are certainly a very well-read person, huh?
That's my passion.
Okay.
Trading.
Okay. The next question is, if it is value investing for a horizon of 10 years for stocks on Bursa Malaysia, what guidelines do you think can apply for the money management and strategy?
Okay, investing and trading are two different types of ways of making. Okay, so the first thing is you need to differentiate what is investing and what is trading. Okay, so investing can be a very different method. Okay, because investing considers that you are buying for the long term, holding this particular asset, say shares, okay, for the longer term. You have various different areas of making money, things like dividends and all that. Okay, so in terms of investing, we need to differentiate between investing and trading. Trading is more for the shorter terms. Trading your expected returns are perhaps a bit more aggressive compared to investing. Investing, if you can get an average compounded annual return of 22%, is already very, very good. If you can exceed 22% a year long term, you already beat Warren Buffett. So it's very, very different way of investing money, right? For shares, I do investing. Okay, but for trading, I use futures. Okay, so for shares, I usually trade long term. I'm a situational trader. I look for times in history when everybody says that shares is something that you should avoid, then I'm always in there when they say that. So the rest of the time, I put my time into futures. So you need to look at your time frame, your expectancy of your return and all that, because investing and trading will be different. Okay, but then certain of those concepts that you see tonight, like risk management and all that, is also good for value investing as well. Okay, so even in value investing, I think if you pick, say for example, you do an analysis and you find that this particular share or equity is very undervalued and you see a very good buy in it. Sometimes some of those trades don't work out. Okay, so you ask yourself, in terms of your money management, in value investing, do I put 100% of my exposure all into one particular share? Okay, so I think you can answer the question pretty well after tonight. You don't, right? So, and also, what is my downside if this share is not performing? And now is there must be a certain point where I say that, you know, I need to quit this share because it's not working, right? So even in value investing, okay, although it's not as intense as trading, okay, you still need to have these considerations of risk and also how much exposure each particular value shares or value investing shares that you want to put in your portfolio. I hope that helps to answer the question.
Definitely. There are a few questions that ask if you can write down the book titles that you have just mentioned. Maybe David, you want to create a slide and write it down because I think visual is more memorable.
Oh, okay. Where do I write down? What's the best place to write down?
I mean, you can exit the full screen, then you create a new slide, and then you just write it down.
Okay. Yeah. While I write down, maybe you can we can get to the other question.
Okay, sure.
Let's see whether I can write down. Okay, I can write down here in the. Okay.
Do you want to take the next question, or I wait for you?
No, yeah, I can take the next question. I can
worried you will be
think while I.
Worried that you will be distracted. All right. So since we are talking about risk and money management, what is your advice in terms of money allocation for equity market, bond market, gold future option trading with expectation of 20% annual return?
Oh, that's a very big question. I wish I can answer that question thoroughly. Okay, asset allocation as in what is? I think that's too big a question for me to ask in terms of this topic tonight. Yeah, so it's a big question. It's so multifaceted that's impossible to answer properly. So I would I'm sorry I would have to avoid this question. It's just too big of a question. Yeah, if you don't mind.
Understand.
Yeah, this is a fund manager's question. Okay.
Okay, maybe you can find David Yamcha. Okay, then maybe you can spend 2 hours. Okay, to dissect each market for you. Okay.
Let's take the other question. Okay, I've written down Ralph Vince, Ryan Jones, and Ben Tapp. You just Google these three writers and you put money management next to it. You Google money management and all the books they write would come up. These are the main people that I reference to in terms of money management. Okay. They can see, right?
Yes, you can see.
Okay, so these are the three writers that will recommend that you start
Ralph
your journey
Vince,
in
Ryan Jones, and Van Tharp.
Yeah.
Are they Americans?
I think so.
Okay.
Yeah.
American authors and traders.
I think so.
The next question is by Albert. For stock index, the liquidity is quite low. I think he refers to futures. Stock index futures liquidity is quite low. Sometimes less than 8,000 contracts per day. Is this normal, and how can BTA traders mitigate this?
Okay. For 8,000 contracts a day is still a tradable contract. Okay. But if you look at the FKLI, it's just that it's stuck in the range for such a long time. I can bring out the chart actually, and you will look at the okay, I'm waiting just a second. Okay, this is palm oil. If you look at the chart for FKLI, it's been stuck in a range for a very long time. So as the market gets stuck in a range, you'll find that the FKLI, see, it's stuck in this range. Only the last couple of days, this is the hourly chart, okay? But if you look at the daily chart, it's been stuck in a range for such a long time, since September. Okay, it's stuck in this range here. So for a while, people have found that it's quite difficult to make money because it's stuck in this range. So the interest is lost. But then once it breaks this and the things start to move, then it will get active again, right? Also depends on how big you trade, Albert. If you're trading less than 20 lots, I think 8,000 traded per day still is a tradable contract. Yeah. So for FKLI, it's a bit seasonal. When the what do you call that? The trades go. Let's put in a indicator of volume. Let's have a look at the volume. 8,000 is still tradable. When I started the business in FKLI, one day only 50 lots. So 8,000 compared to when I first started is way a lot as well. Okay, so this is the volume. Okay, yeah, this is the volume. Yeah, so volume here 34,000. Depends on the day lah. Yeah, depends on the day. The high volatility, the volumes will go up. Yeah, the last couple of days I think volumes have gone up a bit as well. Right, so yes, average of 8,000 is still tradable, but you can see here because it's stuck in the range, so it makes difficult. So people kind of lose interest. But for FKLI, once the what do you call that, the activity starts again, then you see the trades will pick up. Okay, and the bids and offers for FKLI is also still very good. So in terms of liquidity, being able to get in and get out of the FKLI, it's still very healthy. So I hope that answers Albert's question.
All right. The next question is, David, just now you mentioned about position sizing, and we see that the aggressive strategy has yielded a very negative outcome, whereby not only you don't you actually lose money. Okay, your $100 become $31.
Yes.
So would you recommend that, because we see that the expectancy for the moderately aggressive, which is 25%, you bet 25% of the total account on each flip, you yield 36,000 out of the $100. So would you recommend that we do 25% instead of like 3 to 5% risk? What do you think?
Okay. If you recognize this particular trading system, and if you recognize the 25%, 25% is actually the Kelly's theorem. Okay, that's Kelly's formula for the optimum exposure for this trading system. If you input all this data, the win percentage and the win-loss ratio into Kelly's formula, you will get 25%. Okay, but Kelly's money management system, or even the evolution of Kelly's system, which Ralph Vince went to evolved it into Optimal F, which is still considerably very aggressive. Okay, it's too aggressive for trading, and you have very aggressive drawdown that you cannot survive. That means if you use 25%, you have drawdowns that you won't have enough capital to trade anymore, right? So in terms of looking at 25%, that's way too aggressive, right? So 25% you put it into a trade. If 4 trades you are consecutive trades wrong, you are basically you're out of the game, right? So that's why maximum even at 5% is on the more aggressive side of the range. So in terms of the exposure you take for every trade, so it's advisable to put yourself between 2 to 5%. Okay, you can go aggressive in another way, where let's say, for example, if you are in a trade, okay, and you've got some buffer in profits that you have already in the trade, then you can increase your position size without increasing your risk. That means the stop loss, if it doesn't work out, if let's say, for example, you multiply, you pyramid upwards, that's what we call pyramiding up, increasing your size as you make more profits for that particular trade, yet your stop loss and all that is still within that 2 to 5%, then that's all right. Okay, so that is when you catch a good trade and then you want to maximize it, you add in more trades, but then your risk still remains the same. Okay, that's the way to do it if you want to be more aggressive, rather than take a more risk in terms of the absolute stop loss. You take more risk because you have buffer in your profits, and you can increase your size because of the profits that you have. I hope that answers the question.
Okay, so for this Kelly system, because he tested out with all these 10%, 25%, 40%, does that mean that her system has a better risk to reward? That's why they can turn $100 to 6,000.
No, because the Kelly system, let's say, for example, if you lose money on the 25%, you can go down lower and lower. Let's say, for example, you started with 100, then you lost 25%, then it's 75, 25%, 25% of 75 is a lower figure. You can infinitely go down, you see, a quarter of it. But in trading, you cannot, once you get down below 4,005, you cannot trade anymore. Right, it doesn't. It's very different in terms of this particular game, right? Because this game you can go lower and lower. There's no like if it's you have $20 left in your account, you can't trade. But in futures, it's like okay, less than 4,005, you cannot. You see, so that's where the limitations and where Kelly will get stuck.
Okay.
Hope that
The
answers
next
the
question, which I think is the last question, is when you do trading, will you take into consideration of fundamental factors when making trading decisions?
Yes and no. It's good to have a fundamental view of, say, for example, for palm oil. Okay, if you're trading palm oil and you're in a certain kind of position, the fundamental views will sort of kind of support your view and see whether your particular position is in sync with the market fundamentals. But I don't use fundamentals to trade. Okay, I just see it by the wayside is something that I can and see what's the background and what's the landscape of my particular trade. Okay, in fact, and going in even deeper into trading, my trading tends to go into more money management than even calling the direction. More importantly is am I correctly positioned in my money management, okay, for this particular trade. So in terms of direction, so long as I'm in sync with the market, either ABC or AO, I'm in sync with the trend of the market, I'm okay. Okay, so I'm not so invested into whether my particular view is in synchrony with the market fundamentals, because market fundamentals can be very long term, right? It can be month and it can be a year kind of thing. So I'm trading intraday, so I'm a very small fraction of that year-long fundamentals. So today may be different, tomorrow may be different. So in that kind of time frame, fundamentals doesn't help me. I hope that answers the question.
Definitely. Okay, so I guess our time's up. So let me introduce you to our next webinar, which is on the concept pemikiran pedagang yang berjaya. Okay, so if you want to join these sessions, which will talk about the building the winning mindset of a successful trader, that will be conducted in Bahasa Melayu. So it is happening next Thursday, 8:30 to 10 o'clock. So I've just given you the registration link. So if interested, please register yourself for this session. All right, so before we leave, just want to highlight to you that we have post webinar survey for almost all our future sessions. So just respond to our survey and we will pick 6 lucky respondents to win this touch and go e-wallet reload pin worth 50 ringgit. So just answer our survey and then we will pick 6 lucky winners to walk away with the 50 ringgit touch and go e-wallet reload pin. So the survey will be launched after this webinar and will be sent to you via email. So lucky winners will be reached out within a week. Yeah, so that's about it. So thank you so much, David, for joining our session today as a guest speaker. So I'm sure that all of you here have learned a great deal about mathematics, about probabilities, and about how to build a successful trading system and manage your own risk and money management. We cover quite a bit of the technical part of money management, such as win-loss ratio, profit factor, winning probability, those numbers that you must know inside out. Okay, we also cover the key concept of being in trading is, first learn how to survive first. Okay, must put your stop loss. Then if you know how to survive, then you'll be able to prosper. Okay, so this is what David put across the point. Very powerful to us today. So thank you, David, for sharing the idea.
Thank you, Shane.
So we'll look forward
Thank you,
to
everyone.
hosting you again yeah, we look forward to hosting you again in December. So for those of you who are interested to join David's session where he talk about psychology of trading, so stay tuned for our upcoming emails. Okay, so when you receive email from us, from our company, or from my name, Shen Chu, okay, please remember to open and also maybe save my email address in your calendar or in your email server so that it won't go to spam. With that, thank you so much, everybody, and may you have a pleasant rest of the day. Stay safe. Bye bye. This is Shen Chu signing off.
Bye bye.
Bye, David.